Hello, guys. What is happening? And welcome to tonight's live stream. So, we have a blockbuster of a live stream tonight. Oh my gosh. Because there has been some significant downside in the markets today. But more importantly than just the sell off today is what happened in the bond market. As I said before, the bond market is the foundation of all lending and the foundation of the stock market. So we're going to talk about the yield curve. I'm going to try and explain it to the best of my ability. Obviously, I'm no genius. So Emil and Jeff explain this in more depth if you want to learn more about the yield curve and everything like that. But I'm going to try and explain this simply so that people can understand it. We're going to go through unemployment, how that rises. And we're also going to go through some of the retail favorites that have been absolutely just nailed, just absolutely killed and steamrolled over the past literally 4 or 5 months. And then we're also going to go over, if you stay to the end, why the buy and hold strategy is a total waste of time and a failing one. And it's a failing strategy. Even in real estate, you can apply, buy and hold is the worst strategy, and it really is. So we'll go through that anyway at the end. So first thing I'm going to jump into is the yield curve, and I'm going to try and explain this as best as I can. So, and bear with me because I'm going to try and be as visual as possible for those listening on the podcast, because obviously they're not going to see what's on the screen, even though Spotify now has video as well. So the video is going to be there. But the thing is, what you're looking at on the screen is the yield curve. Okay. Now this is the yield curve for Canada, but it could be for anywhere. But let's use Canada. Canada is a good example because the yield curve is completely inverted. The US yield curve has inverted, but it's since gone back. So it's been going back and forth between inversion and not, but the yield curve is completely flattened. So it's a similar message from that. But in Canada, the yield curve has inverted. So we're going to go over what that is, what that looks like, what is a yield curve even. So essentially a yield curve, we're talking about government bonds. So this is government debt. And this is really, I know this may sound so boring to a lot of people, and please just stick with me, because if you know this, then it just gears you up more to understanding the financial system and the mechanics of the financial system. And it also gears you up to going and listening to great people like Emil and Jeff Snyder, their podcast. I can't plug that enough. I'm not affiliated with them. I think they are fantastic. Jeff is one of the brilliant minds in macro. So anyway, basically, the yield curve should just be a beautiful curve, okay? And what we have here is far from a beautiful curve. So basically, it's upward sloping. Oh, I don't know what happened there on my screen. So it's upward sloping. So you've got this blue line, which is a year ago. So you can see that's what the yield curve looked like last year, which is much different to right now. It's upward sloping. This is sort of what a yield curve should look like. Apart from at this front end, it should be much more just a straight line pretty much going up. A nice curve. That's what we want to see. But this is not what we want to see. You got inversion at this point here after the 5-year to the 6 years inverted. And then you've got the 30-year inverted over the 20-year. And that's just not a good sign. That's the hallmark of a upcoming recession, and I'll explain exactly why that is in a moment. So hang with me, hang tight here. So basically this curve, you've got to imagine that there's bonds going all the way to 1 month. I think that's the shortest bond, but there might even be weekly bonds. So you've got government bonds that go from a month to 3 months to 6 months, all the way out to 30 years. So if you were going to walk into the shop, let's say, and buy a bond, they're going to give you, if you buy a 30-year bond, that's going to pay you a coupon rate. Let's say it's 3%. every year for 30 years. So good deal, right? Not anyway, but just stick with me here. So a 3-month bond, that is essentially going to pay you whatever coupon rate for 3 months. Now, the thing is, what's really important to realize is how the central bank affects this whole curve, or does it even affect it? And it doesn't really. And that's what people don't really understand. And that's what I want to highlight in this video and bring to your attention, is a lot of focus is always put on the central bank. The central bank controls everything. The central bank controls money. They definitely have an effect on the front end of the curve. No shadow of a doubt about that. But as we go further out, they have less effect. And I'm going to explain exactly why that is with this curve right now. So basically, you can imagine the Bank of Canada is controlling the very front end of the curve, which is the overnight rate. So the overnight rate is 1%, nice and easy number. So let's say a 3-month bond, we've got the 3-month bond here, is yielding 1.46%. So it's yielding more than the overnight rate from the central bank. And of course, it's always going to do that, because who is going to pay, who's going to buy a government bond when they can hold their money at the central bank and get the overnight rate, which is more than that government bond? So you can see how they affect the front end of the curve. But what I want to highlight here about this is the central, like most debt that most people have is not 1 month, is it? It's not 3-month debt. It is actually further out debt. You're talking about 5-year mortgages, 2-year mortgages if you're in the New Zealand and UK, 30-year mortgages if you're in the US. These are long-term things, okay? Now, a lot of corporations do actually finance their debt on the front end of the curve. And this is what I want to highlight to you. So the households, they're more out exposed to the market fluctuations, because essentially what happens and what the central bank does affects the households less than the corporations, because a lot of the corporations are financing the debt on the short term, because they know that the rates are going to be lowest on that short term. So the thing is, they're most exposed to these interest rate hikes that you see. And that's why I keep saying here that you're going to start to see waves of bankruptcies, corporations going bankrupt. We've had statistics come out in Alberta. We're waiting for the latest statistics. Canada is so esoteric with everything. It's just, it really annoys the hell out of me. But, it doesn't matter if your data is for Alberta, national, or whatever. The last couple of data prints we've had, which was just January, February, saw bankruptcies rising significantly. And it's going to be interesting to see if that trend continues, which I'm expecting it will. Because as interest rates rise on the short end, which is this front end, the 3, the 6, the 1s, the 2s, that is going to push up these rates. It has to push up these rates, because who's going to pay for who is going to finance somebody when the overnight rate, like let's say the overnight rate is 2%, who on earth is going to buy a bond that's 6 months and it's 1%? Like, there's no point. It's risk-free holding it at the central bank, so you're going to go put it there. And I'm talking about financial institutions, obviously. But it's incredibly important to understand the mechanics of this, because then you can kind of understand why it inverts. So that's what we're going to talk about right now. And I know everybody is probably saying, like, you're boring the hell out of me, Luke. Talk about something interesting. But this is just important. So I feel like, I hope I'm explaining it in a way that people understand. I'm really not trying to get in depth into this. Believe me, there's a lot of nuance in this, which I'm not going to get into. And if you want to get into that again, like I said, check out Emil and Jeff, because they go into it in way more detail. So the thing is, why does the yield curve invert? Why do you get a 20-year, as we can see on this curve, a 20-year bond that is paying 3%, and it keeps refreshing for some reason. So that's paying 3.074%, okay? And then you've got the 30-year bond is paying 2.848%. So the 20-year, the 30-year, they are essentially, and even the 10-year, so the 10-year 2.92 and the 30-year 2.84. So you've got all these bonds on the shorter end. Let's take the 10-year because this is the one that most people point to. So the 10-year is paying 2.921, the 30-year is paying 2.848. So now we ask the question, why on earth would somebody buy this bond over 30 years if they're getting a lower rate in the 10-year? Doesn't make sense, does it? I mean, it doesn't make sense. This is where it gets interesting. And this is why yield curve inverts. And this is why it's so important to understand this. The reason that the 30-year is lower than the 10 is because people are expecting that 30 years, over that 30 years, rates could go lower, meaning that if they hold that 10-year and in 10 years' time, the government has lowered rates substantially, well, they can't just go out and buy that 10-year again. So they're taking out the 30-year. So it basically means bond traders, or the smart money, as some people call it. I wouldn't necessarily go that far, but I'd say the institutional money anyway. The institutional money is pessimistic about the future. And now the fact that it's on the 10s and the 30s, don't worry so much about that. It's just the fact that it inverts in any case, because all these times when things have inverted like this, it's been 1 or 2 years, and then there's been a recession. These things usually invert, and then it's not very long before different events that unfold, sometimes things that we cannot understand. And the reason that I'm explaining this to you guys is because this has been so helpful to me. This has been just a thing that really opened my mind. And I'll tell you why it opened my mind, because I literally in December, when the yield curve inverted, I sold all my stocks, pretty much all my portfolio. I went mostly into cash, and I took a big bet doing that. And I was kind of skeptical at sometimes. I was like, I've never experienced this and actually gone through it whilst I've had a portfolio. And I didn't know what to expect. And I just said, well, I'll just hold for a couple of years. And then if I have to buy back in, then whatever, I'm taking the loss, the amount it traveled in between. But the thing is, then the cerveza sickness hit, then the recession hit. But the recession hit, and we sort of had a mini financial crisis, which wasn't publicized because everything was talking about the cerveza sickness and what was going on with that. But the Fed stepped in, they bought mortgage-backed securities. The government of Canada stepped in, they bought mortgage-backed securities. The Fed was going to start buying corporate bonds. There was all kinds of things that was going on. And when you really thought about it, you were like, why is that happening? But, that curve is so important because it has like a 90% probability rate. Because if you look in the past, every time the yield curves invert, I think it's like 10 or 11 times that I can remember in history, it's something like 9 out of those 11 where it's led to a recession after that. And even the ones that it hasn't, there's been some type of mini crash, like we had, was that in 2018, where the stock market just tanked all at once at Christmas. But it's incredibly important to understand. And a lot of people say, it's just mumbo jumbo. A lot of people I speak to, they're just like, recession, there's going to be no recession. But then on the other hand, they're saying, oh, gas prices, how does everybody afford to live right now? And it's credit. It's credit. It's always been credit, and it continues to be credit. So anyway, I hope that kind of explained that. And now we're going to go on to something else, which is a hallmark And the same thing is happening in the United States of what is to come. So this article is unfortunately from the state propaganda organization that is the Globe and Mail. I'm not really a fan of them, but the chart, we're just using the chart. We're not using their actual article. So here, this is credit card debt in Canada, and you can see credit card debt went down when all the stimulus money went into the works. Everybody was paying down debt and everything was fantastic. And when did this turn around? In February, January of 2021. Interesting, isn't it? Because it was literally in May of 2021 when we started to get those massive prints of inflation. And the thing is, now it's rocketing up. We're well above the pre-Cerveza highs. We're going higher, and we'll be going much higher because people cannot afford everything that's happening right now. They can't afford the increased costs in their food. They can't afford the increased cost in their gas. And I say that with a heavy heart because it's sad. It's a sad situation. It's essentially, what happens when you have such bad policy and such policy mismanagement. The problem with what happened in 2020 was that the bailout was way too large. It was way too big, and it just completely distorted everything. I mean, when we talk about that curve again, and I'll bring that up again, when the government came in and they started buying bonds, that affects this curve because that drives down the yields on, and it's artificial because if the central bank is coming in and buying bonds, then that's artificially lowering interest rates. So then people, they turn around and they think, hey, this is a good time to borrow some cash because interest rates are low and I trust the government. I mean, the government is never going to mislead me down the garden path. And the government, they're so smart. I mean, God, we just avoided a depression. The government came in here, fired off $7 trillion of stimulus money or whatever. I'm just exaggerating. But, they fired all this money into the system, way too much, completely overloaded the system and broke it. And that's why you've got what's happening right now in the stock market, which is a perfect segue into that. But, what's happening now is incredibly important to understand, to really understand where this goes forward from here. Because the thing is, you have to realize that quantitative easing, these stimulus packages, they don't work. People like to think they work, but they don't work. And that's the problem. And I was well aware that it wasn't going to work this time as well. I just thought, how long is the can going to be kicked? Is it going to be like 2001 to 2005, 2006? How long is this going to last? Turns out it only lasted a year. We had the roaring 2021, and that was it. So not only did they kick out the most ridiculous amount of money, so much that they essentially broke the system, they broke the stock market, they broke the bond market, they also have just distorted things to such a degree now that people are losing faith in the Fed, losing faith in the Bank of Canada. It takes one more pivot and they've lost trust. And once that happens, the world changes like you've never seen before. And it will be like 1929. I'm telling you, mark my words. If people lose faith in the Federal Reserve and the Bank of Canada, that they don't have a clue what they're doing, which is the reality, but people like to believe that they do, then it's over. The whole system is broken and everything will go down. Your real estate will go down. Your stock portfolio will go down. Everything will just go broken. And that brings me on to the markets because that's a perfect segue into the markets here, which are completely broken. And I haven't been trading that long, I'm still a young guy. I've only been trading since 2016. And the thing is, like, I've never seen anything like this to the degree. And the thing I'm telling you is not the declines. The declines, yeah, I've seen declines like this before. Obviously, 2020, great example of that. But bond yields rising against the stock market crashing. That is literally what happened in 1929. And bond yields absolutely shot up. Like, nobody wanted to lend after 1929. Businesses, thousands of businesses went bankrupt, and millions of people lost their jobs. And that was the Great Depression. So everything has a trickle down effect. It starts off, feeds down to the corporations. The corporations, it feeds down to the employees, meaning they get laid off, they get fired, and vice versa. That feeds down to the banks. People start defaulting. So you can see how this process is slow now, because first line is the corporations. And that's why I said we're going to focus more on bankruptcies of corporations over the next while. And they're already rising. So that's a bad sign. If they continue to rise, that will influence unemployment. Unemployment will be the next thing to rise. The next thing after that will be defaults. Defaults will start to rise. People will start to get foreclosed on. And who knows the timeline? Like, could happen within the next 6 months, could happen within the next year. It could be strung out over 2 years. It's very difficult to say. But as they increase interest rates, it just kind of makes that process, it expedites it, because it's like I said, they are changing the front end of that curve. And if they're changing the front end of that curve, and that's where all the corporations balance their debt on this front end of the curve, then guess what? That means tons of them are going into bankruptcy. And that's why I've said in my videos, and that's why I wanted to come on a live stream and explain this to everybody in depth, because I know that only the people who like really are the true supporters of the channel come on the live streams. A lot of people watch the videos, don't come on the live streams, and that's fine. They lose out on these extras, because this is a big thing to understand if you don't understand this, because essentially them influencing that short term, all the corporations have got more debt than they've ever had in history. So 0.5 percentage point affects them massively. And if the stock market's selling off, nobody wants to buy their bonds. And on top of that, the icing on the cake, the Bank of Canada, the Fed is saying, we're going to start selling government bonds into the market, or letting them roll off our balance sheet, which is effectively the same thing. If they're not a buyer anymore, then they're essentially a seller. It's the same thing. So it is crazy. So let's dig into what happened today. So you had absolute carnage in the markets. You had the Dow. Let's take the Dow. Everybody likes to use the Dow as the kind of the big one for the entire stock market. Everybody looks to the Dow around the world, and I trade the Dow a lot, so always know what's going on the Dow. And funnily enough, guys, I said this on Twitter, and I'm not a genius. I'm not the smart guy, whatever that some people may think. I'm really not, and I don't try and big myself up in any way to be that. But I said on my Twitter on Monday, I said probably what you're going to see, and I'll see if I can pull up that tweet. I said something like, probably what you're going to see in the markets is a positive rally off the interest rates. And how did I know that? Because it happened last time. That's how I knew that. So I'm trying to find that tweet. But anyway, it was essentially, I said that was going to happen on Monday, because I was expecting it. We're going to have a pump, which is going to come after the FOMC statement comes out. It's going to be negative. It's going to be the 50 basis point hike. They actually said multiple 50 basis point hikes. It was negative. But the stock market, the news media went straight away, ran with the story. Oh, the stock market relief rally, 75 basis points. Here's what actually happened. Here's what actually happened. It's much more logical if you really think about it. I was trading the Dow when this happened. So the Dow essentially started to go down as everybody was shorting it. Everybody was entering in shorts. So it was selling, it was going down. And then all of a sudden, like a bat out of hell, the financial institutions came in. They pumped the market just as much, so much that no hedge fund could hang on to their short position. They were squeezed out. They squeezed everybody out. And all the retail traders, they got on board with that move. And a lot of people will have got on board with that move. And even I got on board with that move, to be honest. And I am technically a retail trader. But I knew to get out. I only banked 200-300 points. The move was over 1,000 points or near or less 1,000 points. So I played it extremely safe because I knew this thing, once it comes back, it's going to come back big. And it did. And I didn't expect it, to be honest, to be right the day after. Like, that's impressive. And they were so pessimistic that they just sold everything literally the day after. Therefore, anybody that hung on to their long position got wiped out today because the Dow was down over 1,200 points at one point. So you can see that right here on this chart. You can see here's the pump after the FOMC statement comes out. There was a dip in there, but obviously this is a 5-day chart, so you can't see the dip. But anyway, and then it absolutely tanked on Thursday and it went all the way down. And again, anybody with a long position was just wiped out, completely wiped out. And this is what financial institutions do. This is how they generate liquidity in the markets. Their job is to try and take most people out of their stops. And that's why you've got to figure out, and it's not that difficult. And maybe one day when I have more time, I'll start a channel for free, like all my channels, and try and teach some of this stuff. But the thing is, the banks are smart in some ways because they know where people are going to put their stops. People are predictable. And that's the reality of it, guys. People are so predictable. And you know what? That goes into the monetary system as well. Because I was thinking about this when I was driving to the massage place. The things I think about, I'm always thinking about macro. I'm always thinking, my mind is just always, ingrained in this right now because it's so important right now to try and wrap your head around things. And I was thinking, you know what? The financial institutions, they really know how to play the humans. They really know how predictable people are. When the rates went artificially low, here come all the adverts on the TV. Here come all the emails saying that, hey, you can get this mortgage. It's a really low rate. Come get this mortgage off us. And they just play with people, play with their emotions. Like, they constantly send me letters in the mail. To this day, I have paperless with my bank. They send me letters through the mail all the time saying, hey, do you want this personal line of credit? We'll give you 50 grand at this personal line of credit. And you can go spend it on whatever you want. And then you'll be in debt to us. And I just find it absolutely insane. But you know what? Funny fact, guys. My mentor is Danish. And the guy, I was talking to him once and he was saying, like, about how he knows the CEO of City Index, which is a massive CFD trading company in Europe. And he was saying, like, the thing is, retail traders actually could make money. But the problem is they never know when to sell. He said that's their problem. He said they know when to buy, but they don't know when to sell. And again, I don't know how I've done this because this was not none of this is scripted. I've literally got the 5 points written down on a notepad here. That's it. But that's a perfect segue into buy and hold and why it doesn't work. And this is basically what I said the golden nugget of this whole stream was going to be, is the buy and hold. Because the buy and hold is essentially that retail mentality. It's exactly like that City Index boss said. He said that retail investors, they know when to buy, they don't know when to sell. No true time is perfect of that of now. So now we're going to head to some of the retail favorite stocks. So just pick an emotional stock. Tesla's one of the ones that's going to be last to go, it seems. But let's take a look at Netflix. Netflix is a good one. Everyone loves Netflix. I'm going to buy Netflix stock because I have a Netflix subscription. Their content's really good. You know, once you get involved like that, you're doomed. I'm just going to tell you that much. But let's look at how this stock is performing. And this is a retail favorite, guys. This stock is a retail favorite. This thing, if you bought like many people did anytime here, you are staring at a big fat loss. And you might say, well, Luke, that doesn't matter because I'm just going to hold forever because I'm an idiot. And that's fine. Notice what I did there. And that's fine. But here's the thing. If you hold, and let's say the stock market continues tanking right now, and then the real estate market starts tanking, and other opportunities arise. You might be able to buy a business for pennies on the dollar. You might be able to buy some property for pennies on the dollar. But when you go into your investment account, all your money's tied up in these loser stocks. You ain't going to be buying nothing, mate. And that is exactly why the buy and hold doesn't work. Because essentially, most retail investors, they go too large on two different stocks. They're not well diversified. They don't know what they're doing with their emotions when it comes to emotions. They literally go with their emotions. They go for stocks like Facebook. They go for stocks like Amazon. They go for stocks like Google because they love these products. They use these products. So yeah, Peloton. Yeah, let's bring that one up. I haven't checked Peloton out in a while, but this is another one. Oh God, I'm probably spelling it wrong. I think it's Yeah, that's it. It's Peloton. What? Yeah. So, I mean, look at this one, $17. Let's go to Google because Google gives us a better breakdown than Yahoo Finance. So I'm going to bring this up. Okay. So let's bring up Peloton and then we can see what the returns are for Peloton because that's important. And you can use this Google thing. For some reason, Yahoo only does it when you're on your phone. But if you look at this and we pull it to a yearly chart, you are down 80% on the year. So let's say the real estate market crashes and you know the stock market is going to be well in the tank if that happens. So let's say the real estate market crashes. Where's your cash coming from? Because all these people who, and I said this last year, I said, everybody is rushing to spend their cash right now. And they think they're the smartest person in the world because they're looking at inflation. They're going, inflation's really high. Don't want to leave any cash in the bank. I'm just going to put it in these speculative stocks because they're going up and everybody's buying Pelotons because the economy's honking. It's on full gas. And that was the roaring 2021. You know, it lasted 1 year. And we're already past that. But Peloton, 80%. And there's some worse than that. I think even Netflix was one of the ones worse. DocuSign was another one. Netflix, 62%. What else we got? DocuSign, 1 year, down 60%. Like, you know, if you're used to average stock market returns like before 2020, you'll know that it will take a long time to claw back that. Like it takes way longer. It's so true. It's not a fable. I can't. I'm losing my words. It's the massage. She focused on my head too much. But what they say about the stock market taking the stairs up and then it jumps out the window is so true. And they mean they take the stairs up because it goes up very slowly and steadily. Normally, if the markets aren't being hugely distorted by funny money, and now the funny money is being pulled out the system, so now it's reverting to the means. Good shout out for revert to means. Named his channel really good. You know, I always say we're like kind of like the two brothers of channels, because his channel is revert to means, mine's market mania. And if you think about it, the market mania was in 2021, and then revert to means comes after that. It's just funny. But even if we take these indexes like the NASDAQ is down 10% year over year. The NASDAQ year to date is down 22%. It's in a bear market. And then the favorite, the SPX, the SPY, S&P, what do they call it? Yeah, S&P on here. So the S&P year to date is down 13.5%, and it's down now on the year. So even the S&P, everybody's favorite, is just down over the year. And this has a lot ways to go. Look at this chart, guys. Isn't that a scary chart to look at? Because it has a long, long way to go. And some of these stocks are getting cheap, by the way. Some of these stocks are actually getting cheap if you're thinking about the past 3 or 4 years or even 5 years. But the thing is, I am not thinking about that, because this environment is totally different. The only time that I would be looking at possibly putting some money in, like the S&P 500, for instance, is if we get back down to these 2020 lows again. And I think we will probably get down there. If this all continues the way it's looking like it's going to go, with rate hikes, rising bond yields, then the S&P 500 could very well get down here, especially with QT. So another one, Robinhood revert to means, recommending that. I mean, that's a classic one, because that was like the darling of Cathie Wood that shot up. Everybody bought that on the IPO. I remember reading something on a forum for this IPO. And I look at forums, obviously. We all should look at forums to see what retail is doing and what the emotions are like in the market. Are people fearful? Are they not? And I remember when this IPO'd last year, and basically I can remember reading this one post. This guy was like, I'm buying, and I'm buying it all for my kids. And if he bought, I mean, I doubt he got in here. He probably got in here, somewhere here. Let's say he got in at $50. He's now at 10. Like, he has just been erased, like wiped out. And, you know, how is that? Like, this isn't even adjusting for inflation. I mean, start adjusting for these to real inflation, and it gets a lot worse. But the thing I also want to bring up just before we close here is what happened today, because we had a massive sell-off. But look at what happened to corporate debt. Corporate debt got absolutely took to the cleaners, and some of these ones are down so much now. They are down so much. Like, let's take this core Canadian Universe bond, mostly full of government debt. So that's fairly secure. We know that's secure, but it's absolutely tanking. Like, you're going back. This is government debt, guys. This is government debt. So it's safe, isn't it? It's safe. You're going back to 2007. 2007. Was that a good year? And you know what? I was looking at a interesting report. It was a lot. It was a lot, to be honest. I haven't read the whole thing yet from the Dallas Fed, and maybe we'll go through it in a live stream. But I think most of it is a lot of boring stuff because I was falling asleep reading it. But it was interesting because it was about I think it was written in 2007, actually. And it was about how they were going to avoid the Great Depression and how the Great Depression wouldn't happen again. And basically, it showed charts of what happened to bond yields, what happened to corporate debt during 1929 to 1932. And they just absolutely went parabolic. The yields just absolutely skyrocketed. So the stock market absolutely collapsed in 1929, and yields just, I mean, bonds were no safe haven. And that's what I'm saying to you guys. Once people lose faith in the Fed, they've lost faith in everything. They don't know anymore what they can trust. And that's exactly what happened in the Great Depression. And I want that to be the final message of this video. People didn't know what to trust, and they went into mostly cash. Bank deposits went through the roof in the Great Depression because everybody went into cash. Everybody put their money in the bank or under their mattress or wherever, because nobody felt like their money was safe in the stock market, in the real estate market, because all these things tanked, and people's view of what the money system and how it worked was broken. And that is exactly what is happening right now. It is broken. And, you know, Trader 586 mentions a great point there. I can't imagine what pension funds are going to do. And that's very true, because they hold all this garbage, all these bonds. That's what they hold. So how are people going to retire? Because the stock market might still be up, but if a lot of portfolios are 60-40 stocks and bonds, the bonds have absolutely collapsed. So their portfolio is down because of that. So that's a very, very interesting point. And the thing is, it's going to lead to more debt being racked up, which we're already starting to see. People, I mean, we're already seeing the fruits of that as people who are getting older. They don't have the pension, they don't have the money. They go to their home equity bank. They go, you know, to all these different things. They do a reverse mortgage on their house. The thing is, guess what? There's no real estate to be inherited then for their kids or whatever. After that, that's gone. The bank is getting that at the end of the day. And that's just the pure truth of the matter. And people will think, oh, I'm going to be safe. They will try and rationalize and say, I'm going to be safe. I'll be safe because my market is immune because the sky is blue today, and that means my market is immune. No market will be immune to this, because this is the lending industry. This is the financial industry. This is what underpins the entire bubble economy. The bubble economy is centered around debt. It's centered around credit. It's a broken system that's been broken since 2008, and it's just catastrophically blew apart now. So reasons to be optimistic, I don't see any. I see reasons to start thinking of how you're going to make money if you lose your job. I see good reason to do stuff like that. I see good reason to learn how to grow your own food, because there's going to be food shortages. I just can't be optimistic in this environment. And the dollar is going parabolic. Gold was up today. This is like the Great Depression all over again. So it is really, really crazy. And the thing is, guys, it is just absolute insanity out there. And eventually it's going to lead to, right now in real estate, for instance, because that market is always lagging behind everything else. You've got some fear, but you've also got a lot of euphoria that's still going around. So there's elements of both in the market, and depending on which market you're in the country, there might be more euphoria or more fear. Like people might be thinking, oh, Nova Scotia is still cheap, so I'm going to buy in Nova Scotia. What could go wrong? And then they see 60% declines in real estate because they don't understand the environment. They're just rationalizing, making really risky decisions at really risky times. And that's what everybody has done. I feel like we've seen so much hysteria that it has clouded people's judgment. The mania, the market mania that we've had over the past year has made people do the most ridiculous things. A year after they're being laid off, they're packing their bags, moving to Nova Scotia, buying a house there, they're working remote, and then they get a phone call a month ago saying, hey, you got to come back to the office or we're cutting your pay 30%. These things are happening. The amount of money that some of the companies are paying for remote jobs is laughable. It's laughable. So people who are remote workers and everything like that, working for a corporation, like they don't own it, they're not producing it themselves, the product or service or whatever, they're just an employee, part of a structure. Those are insanely at risk, because the first people that are going to be cut are probably going to be the remote workers. They're going to be cut, or their pay is going to be cut, because again, it leads to human emotions, because people are going to be like, well, I don't see that person. They live in Nova Scotia anymore, so I don't really care. I'll just fire them by email, or I'll fire them on a Zoom call like that guy did for that mortgage company in the US. You're going to see more of that, and it's going to happen. And the people who moved away, they thought it was a risk-free trade. They thought, hey, this is really smart. Interest rates are really low. We'll go buy this cheaper piece of real estate, even though it's gone up in relative terms in that town. We'll go and buy that piece of real estate. We'll live there, cheaper lifestyle, not realizing the risks that they took. And the banks, they don't care. They're going to give you the loan. They do not care. They're irresponsible. One thing that really opened my eyes, and then I'll close this off, guys. I'm sorry, I'm rambling on a little bit. But when I used to hear people a lot go, the financial system, Luke, is really solid in Canada. You don't know what you're talking about. They have this stress test. They have all these different things. And I thought, you know what? Instead of just sitting here, like I've always done in my life, I've said, you know what? I'm going to go ask people, or you know what? I'm going to go get a pre-approval. I'm going to go find out firsthand what this great financial system is really like. So I go to the bank. Bank says, I'm going to give you this loan. I go to the mortgage broker. Mortgage broker says, I'm going to give you 30% more with the same bank. And I'm like, how does that work? Like, how does that work? How does the broker give me 30% more with the same bank, but the bank won't give me that? And I'll tell you why. Because the banks know that the brokers are a great cover. So they can let the brokers be reckless. That's what they want them to do. They want them to be reckless with their lending, to keep that money machine going round. That's what they want. Just keep on churning that credit out. Keep on all the news media articles you see. Buy a home. This person's just bought a home. Who's behind those news media articles? The banks are behind those news media articles. They're playing with you. They are playing with your head. And that's the funny thing. People don't realize it. And anyways, I go to the bank, I go to the mortgage broker, I look at it, and I go, okay, they're saying they'll give me this. This is my payment right now with interest rates at rock bottom. Well, they weren't at rock bottom then. This was January 2020. So it was before this all happened. And then we got redone again, I think it was in later on at some stage, to find out what was different. And we were offered even more. Even though rates had gone up, we were offered even more money. How does that work? So anyway, the payment was substantial. Like if we took out the maximum amount and one of us lost our jobs, we would be up the creek without a paddle. We would be screwed. We would be wiped out. If we were in a market where we couldn't sell the house, we'd be screwed. We'd be in foreclosure. And that's what the banks want. They want you to be screwed. They want you to be screwed. They want you to borrow more money. Always borrow more money. Hey, you know what? Let's just say, hey, we're going to give you this much. You want to buy, it's like Scott says, people go, I want to buy this house for 500,000. They go get a pre-approval, find out they can get 700,000. So now they go, I want to buy a house at 700,000. But they don't realize what they just did. They just played into the bank's hands completely. So these banks are reckless in Canada. So the stress test, all this BS that I've heard over the years just infuriates me, because I know firsthand that it's a load of BS. And I know firsthand how because most people are going to take out the maximum loan that they can take out. Most people moving to Nova Scotia from Ontario are going to buy a massive house on a big acreage for a lot of money, and they're not going to be able to afford the upkeep. Most people moving from BC to Calgary are going to buy a big house for $1 million after they sold their house. They're not going to come here, buy a townhouse, downsize. Are you kidding me? They want to feel like they're rich. And that is really the point. The banks, from start to finish, they screw us completely. Absolutely. End of. They screw us completely. They screw the retail traders. They screw people getting mortgages, and they love it. And they love it. And they play with your emotions, because people are predictable. So what do we got to do? Not be predictable. Amen to that. Arthur, thank you so much, my friend, for the super chat. Really didn't have to do that, but thank you so much for the support. I really appreciate this. As I've said before on this channel, I don't come here to make money. I come here to give back, and I come here to hopefully give back, and people, learn something off what I know. And then I can go, I don't learn these things from myself. I'm not the smartest person. I learn these things from people who are way smarter than I am. And that's what you should do too. Listen to these people that I recommend, because they are very, very good. Emil, Jeff, check out Revert to Mean, Scott Walters, some of the people I've mentioned in today's stream. Anyway, today's stream, fantastic stream. Thank you so much, Arthur. Let's do some shout outs. Trader 586, Philip, Revert to Means, Arthur, DMPR, Negative Celsius, Mr. Fool, All Nighter in the house. Mr. Fool's in the house as well. Benjamin's in the house. Nice to see you, Benjamin. Prashant, I'm probably butchering that name. I apologize. Anyway, guys, thank you so much. If you don't mind, please hit that like button, because if you hit that like button, you know what it does. It's going to publish it on YouTube, more places. Maybe we'll get a couple of more minds opened up. Who knows? Who knows? I don't know. But anyway, guys, thank you so much. I love all you guys. Peace and love. Take care of yourselves. Bye-bye.